This is the Sensei Podcast, where we help you make sense of investments and financial markets, where we help you make sensible financial choices. I am your host, Ndwati Karanja. It is always sad to witness a financial fallout where people have lost money in a particular investment, and the feelings are almost always the same. There is a lot of stress and there is a lot of shame that they ended up being caught in that situation. Something that I came across about a month ago is the bankruptcy of a company that was called Celsius. And the way the company operated was that people would buy cryptocurrency and then deposit it with the company. The company would lend out that currency to other people and then pay these investors with high interest. From the way that report was written was that people had invested stuff like their retirement savings, children's education fund, and also there was actually a man who had borrowed $525,000 and then invested that money in that company. And the sentiment is that they did not understand how risky that situation really was. And whenever we're investing in anything, it is very important to understand the kind of risks that we are taking on. And the purpose of this episode is to remind us some aspects of risks that we can always keep in mind whenever we are investing. First of all, we can definitely measure the amount of risk that we are taking. And once we understand the kind of risk that we are taking, there are ways that we can manage our investments to make sure that we do not suffer catastrophic loss. First of all, risk is not some abstract concept. Risk is actually a real thing that can be measured. You can actually know how risky the investment that you are taking on is. The truth is that most of us, we often do not know how to tell how risky an investment is. And referring back to that example of Celsius, the people who invested in it kept saying that they thought that they were taking on a reasonable amount of risk and it was worthwhile. And that statement by itself told me that they really didn't know how to measure risk. And the way risk is measured is by the variance of the value or the price of that product. If you have a product where today it is worth, let's say, $10,000, then tomorrow it is worth $20,000, the following day it is worth $5,000. You see, the price is varying quite significantly, and that is an indication that that product is quite risky. On the other hand, if you have something like that is worth $10,000 today, tomorrow it is worth $10,500, the following day it is worth $10,000 again, you see that there isn't that much variation in the price of that product, and so it has much less risk than the first example that I gave. If they checked the price history of the cryptocurrencies that they were investing in, they would have seen that it varied quite significantly to the point that you will not trust your retirement fund in something like that. And so when you are investing in something, first of all, get a history of the price movements of that investment and see how much volatility there is in it. If you can remember your statistics and if you understand how to use Excel, then you can find out the standard deviation of those prices. And if you find yourself in a situation where you cannot get that price history so that you can check how volatile that product is, that in itself is an indication of the kind of risks that you are facing, because there is no information about that product that you can base your buying decision on. So don't invest without doing your own due diligence. No information is definitely a sign of information that you do not know enough about that product. So that is, first of all, the way that you get an idea of how much risk you are taking on. The next step that you need to take in order to manage the amount of risks that you are taking on is to make sure that the product that you're taking on is regulated. And one of the great appeals of cryptocurrencies and the type of investment that Celsius was taking part in is that people feel that it is an advantage that the government is not involved in those types of investment. And the thing is that government is not your enemy. It is there to protect you. And the fact is that investment managers make a lot of promises and claims. And if you look at that story of Celsius, you'll find that the people who had invested in it had based all their trust in that organization in what the organization said about itself and what its CEO said about itself. He and his organization kept assuring them that they had one of the best risk management systems in the world, and so these people could rest secure. The problem is that they were just taking them at their word, and if there had been some type of investment that is regulated, there will be another entity, in that situation, the government, that will be checking those claims to make sure that what they're saying is actually the truth. And regulators are always trying to make sure that investment organizations are giving you the truth. For example, in Kenya, for quite a long time, investment companies were selling things that looked like money market funds, but were not actually money market funds. They were way more risky than they are. And over the last couple of years, I think, the regulators in Kenya have been making sure that when companies say that they have a money market fund, it is actually invested in money market type of investments. And so it has the kind of low risk that you would expect it to have. Having that extra set of eyes on the person who is holding your money is not a bad idea. You need someone to watch over your money when you are sleeping, and that is what regulation does. So resist that allure and the lie that comes with thinking that something is safe just because no government is controlling it. That means the person who is actually controlling it has nobody to hold them account, and you can end up facing great losses because there was no kind of oversight. And the final way of making sure that you're managing the kind of risks that you are taking on is to make sure that you are diversified. Never forget this. There is no type of investment that deserves 100% of your saving. I get the situation these guys were in. They were promised high returns, and some of them were advanced in their ages, and they thought that this was the last time that they could make big money, and therefore they decided to throw all the money that they had into that particular investment. One of the saddest bit is that there was a woman who was in her 80s, I think, who had invested almost $30,000 of her retirement money. I think she probably thought that the returns that she will be making from that investment would help her have a comfortable retirement. Unfortunately, it turned out how it turned out, and she ended up losing that money. And always remember that there is never a zero chance of losing your money whenever you are investing. Even bonds, where you're lending money to the government, there is a degree of risk that you are taking. Let me give you an example. The Kenyan government has been doing infrastructure bonds that pay about 11%, 12%, 13% in interest. And you might think that you're lending to the government and there are no risks that you're taking, but there is definitely a risk when you're investing in that infrastructure bond, because it tends to be quite a long-term bond. And so when you buy it, let's say you buy it when the interest rates are 12%. And so that is the kind of interest rate that the government has promised to give you. Let's say a few months later, the interest rates in the market go to 13%. If you were to sell that bond that you bought with an interest rate of 12%, you would have to sell it at a loss, because who wants to buy a bond that pays 12% when there are other bonds that pay 13%? Definitely, your capital is secure if you hold it to the very end of its term, and you're going to get those interest payments. However, if you decide to sell that bond before the end of that term, and the interest rates have changed, have increased for some reason, then definitely you're going to lose part of the capital that you invested in it. So if a government bond like that has some risk that you're taking, other investments definitely have significant risks, and therefore you should not put all your money in that particular investment. So when you're diversified, when you've put your investment in different places, you make sure that you never get completely wiped out in case of an investment going bad. Without a doubt, it is quite heartbreaking when you see people losing significant amount of money, and particularly money that is meant for their retirement, money that is meant to educate their children, or money that they have borrowed that after they've lost that money, they still have to repay the loan that they had taken to do that investment. But that doesn't have to be your story. Remember that you can always measure the amount of risk that you are taking. And if you're investing in something, make sure that it is a government regulated product, and never invest 100% of your money in one particular thing. Make sure that you are always diversified. Remember, what these people are feeling is stress and shame. And by taking a bit of due diligence on your own, you'll make sure that those are not the kinds of feelings that you feel after an investment.